Good afternoon and welcome to this installment of Epic Insight. This is Brian Lenz, Director of Sales and Strategic Partnerships here at Epic, and I will be your host for today's call. We thank you for joining us for a presentation from Charlie Friday, Executive Vice President at Mid-Atlantic Capital Group. Charlie's going to discuss investment management and managed account trends in the defined contribution marketplace and how to leverage cutting-edge technology to position yourself ahead of the curve in that industry. Charlie's been in the financial services industry since graduating from Lehigh University in 1994. He began his career at Ameriprise Financial and several years later joined Mid-Atlantic Institutional Shares, where he was a shareholder and responsible for sales of MAIS's institutional money market and mutual fund brokerage services. After growing to over $30 billion in assets, MAIS was acquired by SunGard in 2002. Shortly thereafter, Charlie went on to found Institutional Trading Services in 2005, which recently became part of the Mid-Atlantic Capital Group of companies. Your line will be muted throughout the call today, but if you have any questions you'd like us to field at the end of the webinar, simply enter those in the GoToWebinar questions panel, and we'd be happy to address those for you. Without further ado, we'll turn it over to Charlie Friday of Mid-Atlantic Capital Group. Charlie, the floor is yours.
Thanks, Brian, and thanks everyone else this afternoon for attending the webinar. As Brian mentioned, I'm going to be briefly going through some of the trends and changes in managed accounts, specifically within the defined contribution employee benefit marketplace. Just a little bit about Mid-Atlantic. We are financial services organization. We have a broker-dealer, an RIA, and a trust company. So we go through a lot of audits and examinations from a lot of different groups. Right now we have about 75,000 customer accounts. We would define that as in the retail space, a customer account, or most of it is employee benefit plans. In the retirement space currently. We have about $70 billion in assets in administration. Along with that, the processing of record-keeping services trades. We do about 1.4, I'd say 1.4 to 1.7 million mutual fund trades per month. So just a little background on Mid-Atlantic. Really what I wanted to talk to, as indicated by the title, is the use of models within the 401k defined contribution marketplace. Models have grown greatly in proliferation, mainly because of the PPA of 2006 and target date funds. I'm going to be talking a lot about target date funds and target date models throughout the presentation, but they've been the QDIA as a result of the 2006 change, and so currently there's a good amount of assets in target date funds, target date models. I'm going to use those two words interchangeably. But just generally the use of models, the 401k investors who use professional help of some sort, definitely the data shows perform better than those who do not. Over a 20-year period, it can result in a very, very large difference. The second line item in the slide there, 55 to 70% difference in wealth accumulation. Also, statistics show that portfolios constructed using help outperform those 87% of the time. There's a brief chart that shows that the help versus non-help of the annual returns, broken up by different age groups. And again, there's been a huge trend, as I said earlier, towards this professional management. There was a large transition from a standalone investment menu to construction, selection of models that are suitable for the participants, going back again to the qualified default investment option. That's poured a lot of assets into target date funds. Every year, Vanguard comes out with a very interesting study, How Americans Saves. If you haven't read that, it's easily accessible from Vanguard's website. But Vanguard being one of the largest providers of 401k plan services in the country. They really dig into the data, and it's a very interesting thing if you haven't read it yet. 40% of all the Vanguard participants last year were in a managed allocation program. So essentially a model of either the funds in the core lineup or even outside of the core lineup put into some type of a managed model. The industry, we believe these numbers are even going to escalate further. The use of target date funds specifically, though, has grown extremely rapidly. A lot of plan sponsors are defaulting their new hires into target date funds. If you remember back in the olden days, if there was not, most of the default was put into the money market fund, which was horribly bad for participants' returns over any time period. The target date funds are used by about 41% of participants in a study. I've now changed this down at the bottom in the disclosure. Another interesting thing I would recommend. Financial Engines this March came out with a study, essentially why are target date funds widely misused, which was the source of a lot of the data that I'm going to show you today. But target date funds are designed to hold all of the participants' plan assets. That is their intention. As that participant obviously ages, the underlying investments within the target date are changed. But again, it's designed, target date funds were conceived to encapsulate 100% of the participants' assets. Today, we find that number 62% of target date fund users invest only partly in target date funds. So what's going on is that target date funds are available to the participants, but they're not using them solely as they were intended. 57% of those participants who started out in target date funds were still fully invested 5 years later. Partial target date fund users earn 2.11% lower in median annual returns than participants who held almost all of their retirement assets in the fund. 2.11% may not sound on its surface by a huge amount, but it is. Over a long time period, that's a very significant number. So the question is, why are participants only partially using target date funds? And the study went into dividing them into full target date users, which they defined as having 90% or more in the target date fund, and they also have partial users, those people that diversify out of the target date fund. One of the things that they found was full users are very different from the average plan participant. They tend to be much younger in age. Accordingly, most of the time they earn a lower income. They have lower plan assets. They save they defer a smaller portion of their income. And they seem to be, according to the surveys, less confident that their assets are appropriately invested. 75% of the full target date users were defaulted into target date funds, and they just tend to stay there. The full users, having the lower age, the lower income, etc., they get defaulted into those, and they just kind of leave it alone and let it ride. But as I mentioned earlier, the benefits are limited by partial users. So only a small proportion of participants are using target date funds as intended, which again is to encapsulate most of their retirement assets or plan assets. The full target date fund users held only 24%. They were only 24% of the total assets of participants holding any target date fund position. And they also represented only 10% of all retirement plan assets in the survey. So what that essentially means is 90% of DC plan assets were not being beneficially impacted by what they call the appropriate use of target date funds. And this, again, is despite widespread usage as the QDIA. People still, as their careers advance, their balances advance, they tend to remove assets out of the target date funds and put them into other investment options available to them. Those partial users more closely resemble the average participants in the study. Average meaning by age, by personal income, and by plan assets. They tended to be mid-career. They had average asset balances, and they also mirrored average investors in terms of risk confidence, confidence that the assets are invested appropriately. And an interesting thing to me personally was, even though they were only partially using target date funds, they claimed that they had a high level of understanding of the target date options. Those who reduce usage over time, they tend to be overconfident. 62% believe they can achieve better returns by not using the target dates as intended. This is really the most interesting thing to me, is that they seek to diversify their plan assets. They want to avoid putting, quote unquote, all their eggs in one basket, but they understand that the target date options are in effect diversified. So they're seeking diversification across investment funds and across asset managers. So that they're pulling out of a diversified, age-appropriate target date fund for the sake of diversification, actually understanding that the original target dates that they were invested in were diversified. They seem to want greater personalization, especially with respect to risk tolerance. And this all kind of suggests potentially that the target date funds that have been the QDIAs for so long may have behavioral flaws that limits their ability to address the needs of the mid-career or later career participants. The conclusions from the study were basically that the target date funds and models appear to be most effective for younger investors with low asset balances and less complex financial situations. The other conclusions were that the managed models, which can of course be target dates or risk-based, may better address the needs of participants who have greater financial complexity outside of their retirement accounts. I mean, as people age and go through the career, their 401k plan may not necessarily be their primary source of wealth for retirement. It is for a lot of people, but a lot of people's financial situation gets complex outside of the 401k plan. And so the study recommended that managed models can play a crucial but complementary role to target date funds in a well-designed retirement plan. Plan sponsors wishing to better serve their existing employees could refine what they call default practices by doing a few different things. One of them was adding personalized advisory services, which is a trend that we're definitely seeing here from Mid-Atlantic's viewpoint with our clients. That is something which is really taking off. The second thing would be adding managed accounts and risk-based models. So you have the core fund lineup, you have the target date options, and then also including some risk-based models for some people that may not fall into or may not want to utilize the other options available to them. Definitely, though, they said continuing to default the younger hires into target dates would be beneficial, continue to be beneficial and has been beneficial, but defaulting the older new hires into some type of a managed account. In order to facilitate that for our clients, and I should have mentioned up front, but Mid-Atlantic is a custodial option for EPIC clients. We have a tool called Model Exchange. It's a web-based platform. It creates efficiencies for advisors, whether they're RIAs or bank trust wealth management groups, who want to use models of ETFs and or funds inside the plans. That you can build your own models using funds or ETFs. We actually manage to settle ETFs T+1 along with mutual fund trades. And it's a proprietary system developed in-house by Mid-Atlantic, and it really was designed and conceived to create operational efficiencies for the advisor and the record keeper. Still to this date, we talk to a lot of people on a daily basis that are running models in what we view as a pretty inefficient way. There's a lot of operational headaches that are going on currently in a lot of situations, and we think Model Exchange obviously is a solution for that. You can rebalance across the model globally. It will affect every plan. If you had 500, 1,000 plans, you made one change to the model, that's all going to matriculate down to every single plan. All the models that manage on the platform are unitized and inserted into the plan as a unique investment option. There's automatic management fee accrual. There's option to have us do the performance reporting and disclosure documents. And we also have a couple hundred managers on the platform today, so you could use your own models, or you could also have a third party manage those models for you. There's no trading limits on it. You can use any combination of ETFs and mutual funds. The funds using the models do not need to be offered as participant-directed options. I mentioned earlier we're going to unitize everything and provide a daily price, and you would then that'd be treated as a model, treat the model as an investment in their systems. I tried to get these screenshots as well as I could. I am not a PowerPoint guru, so I apologize if this looks a little bit small. This is generally, it's called the high-level model processing details to set up a model. It's very straightforward. You set up your liquidity target, your liquidity tolerance. There's a rebalancing policy for the underlying investments for each investment within the model. And you can also set up an automatic rebalancing cycle. In this case, this is quarterly. This is what you would set up when you start a model, when you build a new model. You would disclose your own language and fact sheet content. That's completely customizable by you. We are going to build a fact sheet for your models. They're going to be private labeled and available to any plans that use the models. This is page 1 of the fact sheet, just basic background about the manager, investment philosophy, asset class, Morningstar category, etc. I tried to get this all on one screen or one slide, but I was unable to. This is the second part of it. It's going to show the historical return performance overview, trailing returns, annualized returns, and then growth of $10,000. There's a risk overview, and then asset allocation and top 10 holdings for the model. In terms of rebalancing the model, it's very, very simple to do. This is, as the manager of the model, this is where you set up your investment targets. This is a pretty simplified one. We see a lot more funds in ETFs than most of the models on the platform. To do a rebalance, it's very, very simple. There's a few different, you just select the model. There's a couple different rebalance types, a full, a liquidity, reset it to actual targets, and then you can select for all of your plans or just a particular plan. You hit submit, and that is done. We handle all of the trading behind the scenes. The ETF trades get sent to our trading desk here at Mid-Atlantic, and the mutual fund trades get sent up through our NSCC trading pipes that we have with NSCC. I mentioned earlier, we are going to settle the ETFs alongside the mutual funds. They're going to settle T+1. Historically, that's very, very difficult, if not impossible, to do. You can have a model of funds and you can have a model of ETFs, but to include the same in one model, both of those in the same model, creates a settlement problem, because ETFs trade like stocks normally. They have intraday pricing and they settle trade date +3. We settle them T1. You're going to get any single event for any of the models. We have a very, very detailed history. It's going to show when the trades were released, every single trade that was executed, just a lot of historical information. If there's ever an examiner or any type of internal review, the system contains a ton of information that can go back and look at any activity that has gone on with any of the models or plans tied to those models, actually. And for the sake of the presentation today, these screenshots don't really do it justice. If anyone wants an actual live demo of how the system works, I would obviously do that at any time that you chose. We have 200 managers on the platform today. There's various styles and strategies available. the management of the third parties. So if you didn't want to run your own models but use a third party, they range, of course, from 10 to 75 basis points. We're fully compliant with all disclosure regulations. If you did use a third party, they would take on the 338 responsibility. And core lineup selection and monitoring is also available from some of these managers. You probably, everyone on the webinar today probably do that yourselves, but some of the managers on our platform do a lot more than just model management, if that was any interest. This is just a quick sample, a view of what it would look like to look at a third-party manager. You will be able to pull down all sorts of information, historical information, annual returns, statistical data. One-page summaries of the models are all available on the platform. Obviously, with all the regulations and that are going on today, there's a very, very large focus on fee disclosure within the industry, at Mid-Atlantic, and on Model Exchange. I mean, I probably am in 2 or 3 meetings a week where we're talking about fee disclosure. The treatment of a model designated as an investment, QDIA, the full service managers, you receive benefit of Mid-Atlantic performance reporting, DOL disclosure materials. We can feed data into any proprietary disclosure systems that you may use. We already have connectivity with most of them anyways, and fact sheets are available on the composite for plan-specific performance. I went through that kind of quickly. At that point, I didn't really have anything else to demonstrate to the group today. Brian, did you want to open it up to any possible Q&A?
Yeah, thanks, Charlie. We'll certainly open it up to questions. If you have any of those, please do enter those in the questions panel in the GoToWebinar pane there, and we'll spend a few moments addressing those. And Charlie, we did have a few come in already, so I'll start firing away with you here.
Okay.
You mentioned that kind of the obvious benefits of managed accounts in some form, whether that be a target date fund or a model or a participant level managed account. In light of that, have you guys at Mid-Atlantic seen trends in fund lineups for plans shrinking with a lot more focus on those managed account solutions and a lot less noise of, for example, giving a participant 30 mutual fund choices? Are you seeing similar trends to what Vanguard talked about in their study?
Yeah, absolutely. I mean, historically, everyone thought that to be a great plan sponsor, you just open up your 401k plan to, dozens of funds. There's definitely been a change. I indicated a little bit about it, especially with target date funds becoming available as QDIAs for defaults. There was a huge proliferation in target date funds. We've kind of all read about that. They didn't really do as well as they should have during 08-09. That led to a flurry of lawsuits. When people who are marketing target dates to plan sponsors and fiduciaries, one of the things people unfortunately looked at is performance, whereas with target dates, the best performance is not always what you want. And then since then, we've also seen an evolution towards more of the risk-based models for the participants who are later in their career. They have substantial assets inside and outside of their plans, and they want more ability to manage their own risk. It may just be a personal thing. They just may have a very aggressive risk profile. So we've definitely seen changes in that manner over the last several years.
Okay, thanks. And as far as kind of the target date fund concept, I think was mentioned by the Financial Engine study, was that suggesting that for people in mid-career, for example, they might be better served using a target date fund and supplemented with some other sort of risk-based model to dial up or dial down based on their individual circumstances, or really not using the target date fund at all, and maybe being better served by a individually managed or more specific model?
Yeah, I mean, there were the main two conclusions or implications was that there is mass misuse of target date funds or models. They are not being used as they were intended. People are diversifying out of them for various different reasons. And so the main recommendations that they determined in the study, and I think they looked at, I think they had about 1,000 to 1,100 participants respond. So it was not a Vanguard level study, but they recommended adding personalized advisory services, managed accounts, where things get more personalized for the mid and later career participants. They definitely, even though target date funds were being widely misused, the practice of using those as the QDIA was definitely underlined. That is a great thing. The newer, younger hires behave much differently than the rest of the participants in the study. And they also recommended defaulting those older new hires, which is kind of an interesting phrase, the older new hires, into managed accounts and or allowing them to have access to risk-based models where they can decide outside of a target date what level of risk they are comfortable with. And this kind of dovetails into the whole thing we see going on with the robo solutions. That's the big buzzword these days. There's 10 to 15 robo providers popping up, it seems like, every day. And if you look at any of those robo solutions, they all kind of do the same thing. What they do is they gauge or assess an individual's risk tolerance. So unlike a target date fund, which kind of dials down the risk as a person approaches an age at which they may retire, all these robos that are popping up, and I realize that's a little bit outside of what we're talking about today, but it's kind of similar. They're spending a lot of time determining and divining the risk of participants. So, Brian Lenz, for example, he may be enormously wealthy outside of his 401k plan, and he doesn't want to be in a target date fund. He may want to take much more and much less risk. So there's a large preference in the robo advisor space and really they don't even talk to people. I mean, you could get on a website and do this in 5 minutes. It's how comfortable you are. There's a 93% chance that during the next 18 months a certain market return will occur. Are you okay with that? And it drills down on that, and then it assigns them to a model or a manager that has that risk profile, essentially. So sorry for the long-winded answer, but
no, I think that dovetails back into mid-career. Perhaps there's more dispersion in risk tolerance, whereas early on, younger workers probably all should be dialed up to higher risk. So target date funds may make more sense.
Yep.
A few more kind of operational type questions have come in. One is to leverage model exchange. Do you need to custody your assets at Mid-Atlantic?
The answer is yes and no. It depends upon asset levels and some other things, but the answer really is no. You do not have to custody them with us. We do have options in place where you can maintain custody elsewhere and still use model exchange.
Okay. And what as far as other managers being available, are you seeing some of the managers that are available on model exchange, maybe in light of some of these fiduciary rules that are taking place early next year, are they serving as a plan level 338 fiduciary in some cases as kind of an outsourced provider?
Absolutely. Yeah, I mean, especially with the DOL rule, which I realize that most people on the phone are already fiduciaries, but a lot of the managers on Model Exchange are taking on that role because of the new DOL regs in the RIA space, which is going to have a huge impact, huge consequences in the industry, in my view. But yeah, we have managers that will definitely take on that responsibility, and the number of those managers that will do that is growing.
Okay. And finally, in light of what you mentioned with robo-advisors and really risk tolerance assessment, are there any plans at Mid-Atlantic to incorporate that into the model offering as well, some sort of quick risk assessment to maybe in lieu of a target date fund, push the participant to the right risk-based model, for example?
Yeah, we're working on a solution now that's going to do two things. It's going to figure out the risk tolerance of the participants. It is then going to personalize an investment policy statement for them. So it basically summarizes how they answered the questions and says, based upon those the responses that you've given, this is your risk tolerance. That's a score. It's going to be a simple number. And then after that, it's going to generate an investment proposal. So it's going to say, this is your investment policy statement. This is how you responded to the questions to assess your risk tolerance. And based upon that, here is an investment policy, an investment proposal to use the options available to you within the plan. We do not have that yet, but we are close to rolling out with that. I would say probably later this year or early 2017, that's going to be available as well.
All right. Good stuff. Well, thanks again, Charlie and Mid-Atlantic, and thanks to everyone for joining us on this Epic Insight webinar. We appreciate the partnership and look forward to seeing you on a future session.
Thanks, everyone.